Hello and welcome to It's the Economy. The latest statements from the United States administration appear to signal a thaw. President Trump has said he has no intention to fire Fed Chair Jerome Powell, and Trump and Treasury Secretary Scott Bessent appear to be signaling some de-escalation in the trade war with China as well. However, we haven't seen a very big bounce in US Treasury yields, though equity and gold markets are reacting very strongly. All other risk markets are reacting very strongly. To understand what's worrying, what's moving the debt and currency markets, I have with me an absolute veteran of the fixed income markets, Stephen Major, Global Head of Fixed Income Research at HSBC. Stephen, thank you very much indeed for your time today. While I express my sympathies for all fixed income traders, given the blow hot, blow cold statements you all have to deal with, what is the underlying worry of the US yields? Why is it just refusing to go below that 4% mark, which we did see on April 2nd?
Well, in fact, there's a story here of a different narrative really behind the front end compared to the 10-year. The front end looks like it's quite rational in that it's pricing in rate cuts and doing exactly what you'd expect from weaker growth and trying to look through the tariffs and the inflation that might come near term. The 10-year is a bit more vulnerable to global factors and uncertainty combined with volatility. And I'll just emphasize that point because uncertainty in its purest form would be good for government bonds because it results in deferred consumption and investment, lower GDP and lower policy rates. But when you add volatility, investors require compensation. And that comes in the form of additional yield and a steeper curve. And that's the reason that 10-year bonds are lagging the performance of 2 years. But let's not forget, 10-year yields are down since the peaks around the 13th of January before the inauguration.
Oh, no, that's a fair point. They had touched, I think, 4.78 earlier this year, as you say, January. And it's clearly fallen, but we were expecting sub-4 recession fears. Let me ask you about this conspiracy theory. There are people who say that Japanese investors have been selling. Some people are even proving it with numbers. Conspiracy theory of Chinese and Japanese selling. What's your take?
Yeah, so look, on the first point about what the view was, the consensus view at the end of last year was that 10-year yields were going to go to 5. And so the surprise was that we were heading to 4. The surprise on top of the surprise is that we're at 4.4, 4.5. Now, the overseas selling argument comes and goes. The latest data has suggested that Japanese sellers were there of a magnitude of $20 billion in the recent week. And I guess it's a rational outcome from the news flow that some private investors may choose to de-risk or to take money away from the US. But $20 billion, let's put this in perspective. The Treasury market turns over between $1 and $1.5 trillion per day. It has a $29 trillion free float of marketable securities. $20 billion is a drop in the bucket. It isn't even a quarter of a typical auction size. So I push back on this idea that overseas sellers are driving the yield upwards because, first of all, the yield hasn't gone up. It just simply hasn't fallen as much as some people have recently started to expect.
Okay. Fair point. Okay, rather than ask you to defend somebody else's actions, what's your own expectation? What are you expecting by way of Jerome Powell's actions, Fed actions? And what are you, therefore, expecting on the 10-year through the course of the year?
Yeah, so we have a forecast of 3.5% for the 10-year Treasury. We have an official forecast of 3 rate cuts through the rest of this year and then 2 more next year. The forecasts have not changed. Our 3.5% forecast for the end of 2025, we've had it since the middle of last year. The point is the forecast is the forecast. It's based on scenario analysis, not a simple point estimate process. So to me, when our economist tells me that he thinks the Fed could cut 3 more times this year, I think, well, yes, that's consistent with the Fed's own projections, but also from a more stochastic or probability-based framework, it's a bit like saying there's a 50% chance that they cut by 6 times and 50% chance they don't cut at all. To me, there's an asymmetric bias to what happens here to the bond yields. The bond yields are unlikely to go up very much. I don't think the 10-year will break above 4.5. When the 10-year hit 5% last year sometime, the policy rate was 100 basis points higher. So with policy rates where they are now and expectations of easing, it's very hard, I think, for the 10-year to go above 4.5. And once the easing starts in the second half of the year, I think we'll be on the path towards a 3 handle, and maybe as low as 3.5 as per our forecast.
Okay. Well, let me try and counter this argument just to, try out these contrary arguments. There are people who worry that if the US is working towards reducing its trade deficit with every country, probably even go to a surplus, I don't know, but at least definitely reduce trade deficit, all of us, like India, China, Japan, will all have fewer dollars. There will be fewer reasons to buy US treasuries. So will not that push up yields?
Yeah, so you're touching on the accounting identity that speaks through the trade deficit, current account deficit, and capital account. Yeah. So someone probably needs to explain that to the powers that be in the US, because it doesn't make a lot of sense to many economists. The thing is that the bonds are increasingly being bought by domestic investors. Some 70 to 75%, depending on how you calculate, of the bonds are inside the US, either in the private sector hands or inside the Fed. And that trend will probably continue so that there's even more. And if you look back through long periods of history, whenever there's a recession, domestic ownership actually picks up. Yeah. So I'm not that worried about the bond market. I think that the dollar was overvalued. It was very hot coming into the start of the early part of this year. And so some of the dollar move is actually mean reversion. If you look at the dollar versus most indices and individual currencies, it was overvalued. So some of this is a mean reversion. Some of it is cyclical. And there will be people that tell you there's a secular story about de-dollarization. We would push back against that one as well.
Okay. Yeah, even I find it difficult to believe the de-dollarization story. At least there is no alternative. But Stephen Major, since we have started the conversation into dollar, can you give us your expected range? Are we going to see the dollar index, the DXY, below 100 for a better part of the year? Well,
we've already fallen a significant amount, a double-figure amount. And it wouldn't be unreasonable if we fell a bit more from here. And, you know, the possibility of 5 to 10% is quite possible. I've got a few simple rules of thumb in my head. If you took, say, one of the major parities like euro-dollar, since the euro was created, the euro versus the dollar has been in a range of 0.8 to 1.6. So the midpoint is 1.2. And 1.2 isn't that far from purchasing power parity, apparently. So the fact that the euro's going up and the dollar's going down, again, seems to me fairly consistent. And globally, it looks to me a logical outcome that the dollar should be a bit weaker. Now, the FX markets go through regime shifts, and for much of the last few years, it's been very cyclical. So whilst the US economy was running hot and US real rates and policy rates were higher than everyone else, the dollar was winning with this rate differential argument. But this is too simplistic, because what happens is the FX market can switch very quickly into a different regime, and it could be more structural or, at the moment, more political, because the tariffs really are embroiled in politics, and therefore some of the dollar move will be explained from a more of a political framework for the currency market than a cyclical one.
Fair point. Okay, let me come back to my favorite topic, the bonds. We are seeing contrary moves. The US yields have been high, or at least are not falling, but other yields have been falling, especially in Asia. Can this disconnect continue?
The short answer is yes, and a softer dollar helps the Asian central banks that want to be on an easing path and can justify being on an easing path because of their local domestic data and backdrops. So a softer dollar is consistent with that. What we don't want to see for the Asian markets and actually more globally into some of the emerging markets, we don't want to see a fast move because that would normally be associated with dysfunction or a hard landing. Now, a hard landing may be what we eventually get. A lot depends on the news flow around the tariffs, which of course could change whilst we're speaking. But the reality is, this backdrop does open the door for easing by Asian central banks, and perhaps more than is expected in the forwards and in the consensus expectations.
What's your best Asian market? And per se, your comment on India itself. We have seen a dramatic fall in yields. Is there more to come? Would you be attracted to this market?
Well, our forecast is 6%. We think there's 2 more rate cuts this year. I think that the nature of the momentum that's building up is that we could be underestimating how far yields are going to fall. So if I think there's a risk to our forecast, it's that we're not bullish enough. Oh. If I have a look-back bias through our recommendations this last year, we've been consistently bullish on India. It's been one of our favorite markets. But I always feel we haven't been bullish enough. The arguments for buying India have been based on diversification, and then what is on a relative and absolute basis a strong and stable government with a negative fiscal impulse, a genuinely good, happy outlook. What I fear is that this view is becoming quite consensus. And as a fixed income analyst, I prefer sometimes to be a bit more lonely with my views.
Stephen Major, it's been a pleasure speaking with you. Thank you very much indeed for joining us. And of course, the key takeaway from Stephen Major is going to be that he sees Indian 10-year at 6% and one of the more attractive fixed income instruments in Asia. Thank you very much for watching this edition of It's the Economy. Time for a break. Chartbusters coming up.